I think there's been a few changes. One is that it's become more institutionalized. So it's not just sort of maverick traders all the time, just shooting from the hip. It's become more of a serious money management game. The indexation of commodities has become an important factor. And I think the markets have become more unpredictable lately. So in the last few years, I think with the advent of a lot of volatility in the markets and a lot of long-only funds coming into commodities, it's made the markets a lot more unpredictable. It wasn't considered a serious investment. And over the years, I think, people have realized it has good liquidity. It is real diversification, probably the only way you can diversify out of sort of the mainstream asset classes. And the liquidity and the transparency and the fair pricing, people have always considered, people in the know have always considered that important. But now I think mainstream investors are starting to realize that. Pension funds, insurance companies started getting into managed futures maybe 5 or 10 years ago, and I think it's increasing. So they fall into two camps: those who are actually active in investing and those who want to be active in investing. They want commodity or non-correlated asset classes like commodities. They tend to invest then in long-only commodity products. Then they realize that doesn't produce any alpha, so then they look towards CTAs or commodity traders. And then there's the natural progression into other types of trading strategies. When I started, they just started trading spreads electronically. So that gave us a big edge. We were sort of first into the electronic side of that market, or an early entry. And I think for us, trading spreads is a big advantage. I think there's more money to be made in spread trading. So we trade the spreads, the difference between two contract months. And I think there's a lot of opportunity there that doesn't exist in just trading the outright market. So that's helped us. I think we've been very research focused. So we have a good team of analysts. We do a lot of research. We're very quant minded. But on the other hand, when you trade spreads, you really have to know the market. It changes fast. You have to be adaptable. So you really have to understand the market you're in. And I think a lot of people who are too systematic aren't able to adapt fast enough to the changing markets. Our strategy really revolves around really understanding the market we're in. So for example, a lot of people try to front run the index fund rolls, so they have to roll their contracts. And we do that too. But of course, the index funds are getting smarter and they're changing their roll strategy. So if you don't adapt with their changes, you're going to start losing money. So we find people who are too simplistic, don't understand the spread market and what's going on, they start losing money. Whereas we build models that sort of measure the changing roll strategies, and that allows us to adapt very quickly. What we've done is we've put a whole risk structure in place that does everything from tell us, what the quantity of contracts we can trade in any instrument based on liquidity, what our max drawdown is, what we have to do if we hit our max drawdown, how much risk we're allowed to take over our whole portfolio, how we measure that risk, how much margin are we allowed to use, and what happens if we exceed our margin limits. And we have exact rules on how we deal with every scenario that comes up in our set of rules. People are starting to realize that this is the one asset class where they can diversify that gives them results when sort of all other asset classes fail. It seems to have become very institutionalized, and that means that used to be you'd have a one-man CTA starting out and maybe one or two people in their house sort of trading and becoming a CTA. That's really no longer possible, or it's difficult, because institutions want all kinds of rules, separation of duties, you really have to have a big infrastructure of 10, 15, 20 people even just to get started. So that's the difficult part in managed futures, but I think the world is demanding it, and it's getting bigger and bigger. And I think one of the problems is the main product is just trend following, and I think that's probably a low alpha generating product, and I think the industry's got to expand into new products, and that's where our edge is going to come from. And that probably means more liquidity coming into the market as more people trade, and then we can get to strategies like mine can get to bigger sizes. They just recently started opening these 40 Act mutual funds for managed futures, and the popularity's been tremendous, and it's great for family offices, all kinds of money managers, high net worth, but people can essentially go on Fidelity, Schwab, TD Ameritrade, all these platforms, and buy a managed futures product in their normal accounts, which could never have been done before. The question of that people might have lost their segregated funds, that nobody really knows what's going on, that segregated funds are now in the hands of a bankruptcy judge and a bankruptcy trustee. These are all sort of unfamiliar territory. And the exchanges have always held this idea up to all investors that segregated funds can never be touched. They're always protected. No customer has ever lost money that's held in segregated funds. And now that's all been destroyed. I mean, we all have money at MF Global in segregated funds, and our money's gone. We're expecting to get it back, but nobody really knows the answers to these questions. People didn't want to have their money in a lot of hedge funds and things like that because it wasn't protected. And they always said, well, managed futures, it's in a segregated account, it's always protected. Now what are they going to say? Now that story's kind of gone. Well, the customer has to know that segregated funds are protected. Now, one thing that we, as a CTA, we have our own fund, and our fund has money on deposit with a clearing firm. So we ask ourselves, we have to protect our investors' money. And how do we protect it? So we've looked at means like buying treasury bills in our own name, holding only maybe holding only the monies required for margin with the clearing firm, and having the rest of the money in a custodial account.